Hi, everyone. We're going to wait a minute or so for folks to join us. For now, feel free to share your name, your role, and where you're joining us from in the chat box. We'd love to know who's joining us today.
Thanks, Jared.
Hey, Jared. Hi, Michael. Hi, Rebecca. Hey, Jeffrey. Okay. Welcome, everyone, to today's webinar, Exit Ready, How to Prep Your Trades Business for a Profitable Sale. We're excited to have you join us today. I'm Emily Hill. I'm from the growth marketing team here at Simpro. And whether a sale is on your near-term horizon or part of a long-term plan, you're in the right place. Today's talk will give you clarity, confidence, and practical steps that you can start implementing now. A few housekeeping notes before we get started. We are recording this webinar and we'll send you the replay in case you miss anything. And today's session will run about 45 minutes to an hour, depending on your questions during the Q&A. And please feel free to drop your questions in the question section or during the chat, so that because we'd love to hear from you, and so that our awesome presenters today can answer all of your questions. So I'll quickly introduce you to our speakers and then I'll let them take it away. So today we have Amy Carnrick, former CEO of Foster Plumbing. And after selling Foster Plumbing to a private equity firm, she joined Simpro as a senior advisor, field service transformation. And she really helps us bridge hands-on trade experience with the future of technology-driven business operations. Amy's story embodies what's possible in the trades. She's acquired and scaled a $1 million plumbing company to a $10 million in revenue in just 5 years. And she's executed a successful exit, selling for 6x EBITDA. Now she focuses on helping other business leaders drive more profit. We also have Blake Nielsen with us. Blake is one of the co-founders of Black Iron Advisors. And for the past 5 years, Blake and Black Iron have dedicated their efforts to the subcontractor and skilled trades sector, working closely with electricians, plumbers, roofers, and numerous other specialty contractors. Prior, Blake was a senior vice president at WG Nielsen & Co., where he spent 14 years assisting in all facets of mergers and acquisitions advisory. There, he led transactions with an aggregate transaction value exceeding $500 million. His practice at WG Nielsen & Co. was focused on trades, logistics, manufacturing, and distribution-related transactions. He led sell-side transactions for companies such as the third largest keg leasing company in the world, franchisees like Sealmaster, and one of the largest hurricane protection hardware distributors in the United States. Thank you both so much for joining us today. I know you both have so many valuable insights to share with our audience, and I'll let you take it away.
All right. Thank you, Emily. First of all, I want to say that I'm really delighted to be here today to discuss the topic of selling your trade business. My own background is rooted in being a serial entrepreneur. I've successfully navigated 6 buy-sell transactions, including purchasing and divesting 3 different businesses across 3 different industries. While I may have been a bit braver in my younger days, venturing into those fields without prior experience, I can now share the deep insights of buying and selling businesses based on those experiences. My advice to you is the old saying begin with the end in mind, because you don't know when the end might be. Sometimes it's something tragic or a change that forces the decision. COVID is an example of something out of control. So always be ready. Most recently, I sold a commercial plumbing company, a little bit of a repeat of Emily's story, but I specialized in tenant improvement, construction, and service. I am proud to say that I did 10x that business over 5 years and ultimately sold it for a valuation of 6 times EBITDA. Yes, thanks to Black Iron Advisors. And as you can imagine, I worked all the time. While my plan was to leave the business to my children and leave a legacy, those plans changed because their desires changed. So I was left to sell. After selling, Simpro hired me as a software ambassador, and I'm genuinely thrilled to support small business owners in many ways. I initiated this webinar specifically for our customers and to others, to open it up to trade company owners, because I believe it's critical for business owners to fully understand the worth of their business and why. That way you can take steps to increase your value. I definitely did that. In my own business, I utilized and fully built out Simpro. Without question, optimizing the software directly resulted in an optimized net margin, which is obviously everything we're looking for. It certainly optimized my business valuation. My net margin was 29% and was much higher than most of my competitors. I asked my investment banker, Blake, to join me today so that we can have a back and forth discussion and have an informative talk about selling your business or simply being ready just in case. We're going to hold a Q&A format, so please feel free to ask any questions in the chat, as we will be monitoring it throughout. So to begin, I want to reiterate that every single one of my six transactions was different. So let's start by asking Blake to introduce himself, and perhaps he can kick us off by discussing how business size, types of sales do differ based on differing variables. Take it away.
So Amy, thank you for inviting me. Quick background, as you've heard before, sell-side investment banker and have been for the last 20 plus years. So this is all I've ever done, is help folks with what is typically the biggest transaction of their lives, which is the sale of their business. And Amy, your story is actually a pretty common one for us, where the entrepreneur who founded the business had every intent to transition the company within the family or to employees, but situations change. Sometimes that's the desires of the kids. Sometimes that's for sad reasons. Sometimes it's for great reasons. But often that leads to a transaction. And where we find ourselves serving that client is, I think most of those clients don't realize the scope of options that are available to them. I think it probably makes sense to hit, just before I get to your question, Amy, a quick summary of what a typical transaction looks like. And if you're open to it, I'll use your transaction as the case study here.
Yeah, that's great.
So when you engaged us, we went about drafting a bunch of materials and marketing materials that framed your company in the best possible light, and also positioned it for the type of transaction you were looking for. And then you told us that you wanted us to go out to a pretty large audience. Some of our clients come back and they say, no, we have a lot of concerns about confidentiality, so we'd rather you go to a smaller audience. You said, no, let's go out to a larger audience. I'm confident with my business and my customers. They're not going anywhere, so don't worry about it. So we went out to about 450 people in your case, potential investors who are all qualified to buy the business. And then we had about 82 of those signed non-disclosure agreements. 12 of those submitted indications of interest, and then you received 2 preemptive LOIs. And ultimately, we went with one of those folks that had done a preemptive LOI. But that is to say, of those 12 indications of interest, I don't think you had a single one of those that was the same. They were all different. And we wanted you to be able to interact with a big scope of options so that we got the right one for you, for your family, what you intended, and what you wanted to do after the fact. So that was a long-winded additional preface, but to your question, in
Why,
terms of
well,
size,
let me just ask you
yeah,
really quick, what do you mean by options? Just give a couple of the examples that were available to me.
sure. Yeah. So there are lots of different options. There's a complete sale of the business, which is the one that everybody thinks about, right? So everyone's like, oh, I'm going to sell 100% of it and I'm not going to be involved at all on a go-forward basis. There's a majority recapitalization, which is selling the majority, so greater than 51% of the company, but less than 100. And that's typically people that want to take or go for the proverbial second bite of the apple. So they want to remain an owner in the company, participate in it, but take some chips off the table. So if that's for paying off the house and sending the kids to college and putting a bunch of money aside, de-risking their personal balance sheet and saying, look, this is how we're going to handle it. And then there's also minority investment options for companies of certain size and scale. That's a lot of different, and then of course there are subcategories within each of those. So the majority, the complete sale option, it looks different if you're selling to a strategic, so somebody in your category, or to somebody like a search fund who will come in and operate the company. So there are lots of different options there. You had asked about how are firms valued based on size. So I'll hit on that for 1 second, and then we can jump to your next question. But the market values companies based on their perception of risk. As you get larger, they view there to be less risk with ongoing cash flow of the business. So they pay more for it. And they pay more for it in the form of a multiple of EBITDA. So what you guys have probably heard is that businesses trade off of EBITDA or seller discretionary earnings. So if you're under about $1 million, that's called seller discretionary earnings. The buyer is likely to be somebody who's going to take an active role within the company. Over $1 million, that's EBITDA. So now all of a sudden it's an investor, somebody who's likely buying as an investment. So that's the kind of break point, if you will, for most folks in most trades. Did I answer it loosely
Yes,
there, Amy?
you did, but I want to also ask you how the sale, because I think folks might be interested in where the break points are with how the sales are handled. So like based on your gross revenue, so and some of your net margin, but so like below $1 million, somebody might engage a broker and just put the company on biz buy sell. Above $1 million
Yep.
to 5 million, and then just those break points of the typical representatives, I suppose,
Sure. Yeah, so
and process.
under $1 million, that's likely, as you indicated, to be represented by a business broker. Business brokers typically list companies on publicly available websites. Think it's not dissimilar from a realtor, right? So they throw it up on MLS, and your business is now seen on Zillow, right? So it's not Zillow, but it's Biz Buy Sell and other websites that are dedicated to listing those companies. Over about $1 million, you start to get some options. So there will be some regional investment banks that will start taking the assignment at about $1 million. And at about $2.5 million, you start to get some specialist investment banks like ourselves who are excited to take on that mandate. And who are likely to run a auction process like I described for you, right? So that's direct outreach to qualified investors.
Okay. All right. And tell me about, I know there was a couple of days where I just was like, I'm selling this thing. And I called a few of those emails that we all get. And they said, well, we want this or we want that. And so, and in my own business, I actually listened and a lot of them said, we want more service revenue out of your business before we're interested. So I
Mhm.
paid attention to that. And I, as you know, I opened up a service division. So how important is recurring or contract-based revenue to valuation in this industry? Start off. Go ahead and talk
Oh,
about that.
it's a really big difference. So for firms that are largely project-based or entirely project-based, the multiple is potentially half what it would be if you were to do a very high percentage in service revenue. And you hit on it. The idea, and I'm going to go back to this, values are reflective of the perceived risk. So if you service is a lower perceived risk because it's more likely to be reoccurring. You're likely to keep that client over time and do a lower average ticket more often over time. So the investor believes your company is likely to persist in 5 years and still be servicing those clients. Versus if it's project based, where they worry, what happens if we stop getting projects? Or you are more susceptible to the macroeconomic conditions that are prevailing at the time. So, Great Recession impacted all of us,
Yes.
and if you were really project based, your business was likely to be more impacted than you were if you were service based. And so that's reflected in those EBITDA multiples. And when I say it's half, I mean it's legitimately half. Yeah, so if you're 100% project to 100% service.
What about the service contract versus just service divisions?
This will come down to how skilled your advisors are.
Mm-hmm.
If you because in the perfect world, you'd have service contracts with long durations, right? So you'd have a 5-year service contract that, oh, by the way, is transferable to a new buyer and doesn't have any change of control provisions in it. That's the gold standard on one end. If you are doing pure service work but don't have it contracted, then it comes back to the skill of your advisor, because what they're going to need to do is show the tenure and duration that you've had those clients for. So if you can prove that they've been with you for a long time and that they don't churn out and it really is reoccurring revenue, then that contract is less required, right? They don't need it as much. But if you instead don't have contracted service revenue and you have a lot of churn in that customer base, that is a problem, right? Because now it just looks like I have small projects.
Gotcha. Gotcha. Um, how do this became in our deal? I say our because we worked a lot together.
Yours.
But
Yep.
we the typical the buyer customer concentration importance, and how should people take steps to mitigate it, because that we were right on the line with one
Yep.
customer and that became an issue.
Yeah, so particularly financial buyers, so private equity groups, get really focused on customer concentration. Again, I sound like a broken record here and I apologize, but it's that same risk reward trade-off. So if I have a lot of customer concentration, they will think that there's a lot of risk that if I lose that customer, then the boogeyman's around the corner for every private equity group. They're just going to assume that you're going to lose that customer the day after you do the transaction. So they're going to pay you less for it. And if that means that 30% of your revenue walks out the door because that account is 30% of your revenue, then they're not going to pay you as much, right? And so this comes back to okay, now what? How do I solve it? There are a few ways to do it, but ultimately, and if it's easier for me to say than to do it, so I recognize that I'm taking the
Mm-hmm.
investment banker, not the operator. Ideally, you continue to grow other customers such that they dwarf your one large customer. Okay, I recognize that's hard to do. The other thing that you can start trying to do and to minimize the impact of that is to make sure that you have multiple contacts within that customer and that there are multiple decision makers within that customer. So that if you say, oh yeah, but it's not contingent on one person, it's contingent on a bunch of people. So there are a bunch of project managers that we work for example, and each of them have the discretion to hire us. Well, I can de-risk that big customer a little bit. If I can say, hey, yes, I've got one big customer, but the average project size is relatively small, that too will help, right? Because they'll say, okay, you might lose one contract, but maybe you won't lose the customer as a whole. They will look at that as a little less scary, and so will be willing to pay you a little bit more for it.
My customer was at about 20% of our total revenue, and I was always told that's the magic number, never go over 20%. And it is hard to do, especially when it's somebody that keeps feeding you lots of business. So you do have to fight that, a little bit if you know that you're going to sell. What
And
is
with you, we were able to point to the growth. So what for you, we were able to point to the growth of your service industry and say, hey, in no time, that service department's going to end up accounting for a larger percentage of revenue than that one large client is. And we were able to kind of use that growth on the service side to then reforecast what the likely customer concentration would be next year, the year after, whether that's exactly what transpired or not, and say, hey, this will only decline, so you shouldn't be worried about it.
Gotcha. That and service became about 30% of our revenue towards the end, which was great. So this is always a hot topic. What is the best way to handle personal expenses or non-operational items before a sale? Because one of the great things about owning your own business is being able to write things off as legitimately and legally business expenses, but sometimes those could be argued as personal preferences for a business. So what's the best way to handle those?
Yeah, so the first exercise that I described in your process, drafting materials, the majority of that is time spent adjusting EBITDA to what a new owner could have generated owning that business had they made different choices, right? And so, and those different choices often are expenses that are related to just that owner. So I'm not here to opine to the legitimacy of the expense for tax purposes or anything else. That's not. But my job is to say, hey, with a different owner, how much cash flow could have been generated out of this asset? And so some of that's going to be personally relevant expenses. So travel, entertainment, whatever the case may be. Some of that's also going to be your capital expenditures. So cheers, personal vehicles. Were personal vehicles necessary under new ownership? Probably not. So expenses related to personal vehicle ownership. These are just one of many examples, right? And the answer is they're a bundle. So our adjusted EBITDA, the trick is making sure you start to document them. The other big category of adjustments is expenses that are one-time in nature. So if it was an investment that you would have only made once. So for example, implementing Simpro, I could make the argument that, hey, the entire expense of implementing Simpro should be an add back. So it shouldn't be considered for the purposes of the transaction. So it shouldn't count against my EBITDA. And the reason is because you're unlikely to have it implemented every year. It's unlikely to be reoccurring in nature. So I should be able to adjust that back out, right? And that should ultimately help the value of the company.
This brings something to mind. It's very important that whoever you choose to represent you fully understand accounting. I had one of the persons that I interviewed told me I needed to go back and refile all my taxes, and I quickly fired them or quickly walked away, but because I filed them correctly. And the fact was they couldn't understand my taxes because they were so complex. So it is really important that whoever you choose fully grasps all the high level accounting things that, generally speaking, us small business owners have not been exposed to. So I highly recommend that.
So, and you were asking, Amy, like, what are things to do to prepare? So the answer is, I'm not afraid of any of those personal expenses or personally relevant expenses, because we should, as long as they're legitimately personal in nature, or they are expenses that are only relevant to your ownership, we'll get those add backs. Those add backs will happen. What you want to start doing is kind of just taking a note of them. Hey, we've got a cell phone plan that probably isn't necessarily the one that we'd have if it was under different ownership. Or go down the list of all of the expenses and just start taking notes of them, ideally years in advance of a transaction, because it will just make the exercise when you do go to market a lot easier, right? You ended up having to do a fair bit of digging. Not that you can't do it, not that you can't go dig back into the accounting and figure them all out, but sometimes it's easier if you just keep a little running total there of, hey, this was probably personal in nature, so we should make sure we account for that.
Yeah, I was so cheap. I bought all salvage vehicles. So I was worried about that for a moment. So what are the type of advisors, just kind of that we should include, like, obviously a CPA, an attorney, and making sure that depending on where you're at, that they're the best in class for you and where you're setting out with your business.
So
What
in
other
both
advisors?
cases, Amy, yeah, in both cases, make sure it's somebody that the person that's been filing your tax returns year over year might have a bunch of M&A experience, but they might not. So you want to double check. You want to just make sure that they've got experience there, because there are things that can be done to make sure to minimize taxes. I'm not saying, not pay taxes. I'm saying minimize the tax impact of the transaction. So you want to have an M&A advisor who's got the relevant experience. You want to have the tax expertise that's got M&A experience, and then your attorney needs to have M&A experience also. Don't pay for anybody's education. If they haven't been doing it for a long time, don't use them.
Yeah.
Use somebody that does this day in, day out. And then one other relevant conversation, the transaction type particularly matters for those two other advisors. So if they have not done a bunch of equity deals and stock deals, get somebody who has, because that will look a little different. So if their specialty has been asset transactions, that's fine if you are going to do an asset deal, but there might not be the right person if it's a stock deal. And you just want to ask that next level question to them.
For me, a stock deal in the US, I think, is the holy grail, which is what I was able to do. So it's really important that people understand what they're getting into. For the owner that I bought it from was taxed on the sale 45%. And there goes all your hard work out there. So I just want to make sure that you guys think about that. Then that's part of, getting ahead of this, is thinking about those types of questions. How long, and Jared has a really good question. I'm going to skip to one more thing, and then I'll try to figure that out and ask it. But how long does a typical transaction take? Ours was actually fairly fast, I thought, but go ahead.
Yeah. I think you should anticipate and be ready for a transaction to take 6 to 9 months. The client, in every case, is the reason we go faster or slower. So it's, how long did it take to gather materials for the marketing materials? How long did it take to survive due diligence and provide the 500 items that are going to be requested by the buyer? How many turns did we take on the purchase agreement? So inevitably, it's the client who ends up determining that timeline at some level. But the expectation that I believe you should have is that it takes 6 to 9 months. If you said, hey, I need it to go faster, the answer is it can go faster. If somebody said, hey, I need it to transact in 4 months, it can. Here's the trouble. You're not going to see every transaction structure, and or you're just not going to get the full value that you might have gotten if it went a little slower, if you can be a little bit more deliberate about it. That said, it is not uncommon in trades in particular to get preemptive offers like you did, Amy, which end up shortening the process materially, because rather than getting kind of through that process with all the perspectives, you just say, great, you're gonna have to bid up for the asset. If you want to go fast with us, that's great, but you're gonna have to bid a higher number to get me there. And I'll go fast with you, but you got to bid up for it. And that can occasionally work.
Gotcha. I don't know. Can you see Jared's question here? What I'm reading is essentially he's got a summer heavy business, and he's been 3 years.
Congratulations on the growth.
Yeah, tremendous growth. But unless you've bought equipment, potentially, I'm thinking landscaping company here. Is that potentially one of the things? So because at the end of the day, the bottom line has to, they're going to want to see some offset so that your EBITDA can be addressed in your bottom line. Am I right? Am I reading this right here, Blake?
Yeah. So Jared, I'm gonna make a couple guesses here, and then you can correct me if I'm. So the answer, what I'm hearing from you is, hey, we've really grown our top line, but our bottom line hasn't grown. So is my business really still worth the exact same as it was before we really went and grew top line? The answer is probably not. You can probably assume that you will get more value, but what we end up needing to do in a case like yours, and this isn't knowing enough information to answer it perfectly, but what we probably end up needing to do is look at it and say, hey, what could a strategic acquirer, using their margins, what would they likely be able to generate as EBITDA from this business? And we would do something called a synergistic EBITDA look. So we would come back and say, hey, industry average margins are the following, they're X. We're performing a little under that. What we would then do is we would say, here are the 12 reasons why we are, but this is why you, Mr. Acquirer, would be able to generate this in EBITDA. And then we try to get people to bid off of that revised value. If what you're saying is, no, just the pure seasonality of our business means that we are unlikely to have better margins than this, then what you will see is people, because your revenue has grown and because your diversification of your revenue is likely grown, people will pay a higher multiple on that EBITDA than they would have, 3 years ago before you had all that revenue growth. But it won't feel like you got as much of a premium as you should or as you deserve, because ultimately these companies are valued based on the free cash flow they're likely to generate an acquirer, right? And so if my free cash flow hasn't shifted, the premium only comes in the form of the multiple.
Yeah, that's kind of what I was thinking too. So what steps should a business owner take 12, 24, 36 months before a transaction to maximize value? One of the things I did was, again, adding a service division and really focusing on that and to increase the likelihood of their successful outcome. And I think, like I said, I made those desperate calls. And people said, oh, you really do have a great business, but you don't have any service. And we really want service. So I was like, oh, well, if I ever really mean it when I want to sell, I better start a service division. So, because we had a lot of options that may seem pretty obvious, but we could have gone into industrial. We could have gone into so many different areas, med gas, whatever. So that definitely made that decision for me. So
I'll give you a couple scary ones. Yeah,
okay.
I'll give you a couple scary ones. So building out your management team and such that you have management depth ultimately will pay sufficient dividends to pay for those salaries. I know it seems scary because those salaries are material, but most trades entrepreneurs wear too many hats. Most of them are still responsible for 15 things inside the company when they should really be responsible for two. And the more you build out that team and the more that you make it appear that you can walk out the door the next day and that the company will continue to grow and do well and thrive even without you there, the more somebody's willing to pay for it because it looks lower risk. The next one, customer relationships. I know this one's scary for every entrepreneur. And look, some of you might not be in this position, but I bet a lot of you are, where those key customer relationships reside still with the entrepreneur, even as the companies grow and scale to very large sizes. In our experience, entrepreneurs are reluctant to let go of those customer relationships. The problem then comes back to if you want to transition out of the company over any reasonable time period, that will scare an acquirer because, oh, by the way, the owner left and now that key customer left. And so the more you can push those relationships and diversify those relationships within the company, the better off you are. The more somebody's going to be willing to pay for it.
I guess I'll say being in a male dominated industry, I don't fish, hunt, or all those types of things. So I didn't have an issue with that. So I did kind of shy away from those types of things that are so popular among customer building activities. So I do think that's true because a lot of my trades business partner friends are like that.
Well, they loved you for that. The fact that you were like, no, I don't take them out. I don't, and they don't know me. That's not you were able to put every one of the potential buyers at ease the moment you said, no, I'm not taking them to a football game tomorrow. That's not how I've done it. That's not a knock on the folks that do. Cheers. Just make sure that it's not just you doing it, right? It's got to be, you got to diversify those relationships within your team enough that if you do want to go to the beach after you do your transaction, that customer isn't likely to call their next best friend.
Right. Gotcha. That's a good one. Any other on the 12, 24, 36 months? Just.
Oh, the answer, I could list too many things. I think the one that I would encourage people to do is start trying to build your team earlier than you think you need to. So start putting together your accounting advisor, your attorney, your investment banker earlier than you think you need to. Because there are some things, for example, where we can say, oh, hey, you're still using cash basis accounting. I'm not using you as the example here, Amy, but I'm saying plenty of folks that come to us, even at 15 of EBITDA, come to us and they're like, hey, we're on cash basis accounting in a project-based trade. And I sit back and go, well, that's going to be a problem. We got to start looking at this. We got to do an accrual conversion. We got to do an accrual conversion. We got to start presenting this according to GAAP so that we can survive due diligence, and so that what we present in the confidential information memorandum is the same as what is going to emerge at the end of the quality of earnings report done by a potential acquirer.
Why don't you explain what a quality of earnings report is? That's a good question. Because that was new to me on this transaction.
Yeah, and a lot of folks in my industry will call it a QOE or a QFE, which is a quality of earnings report. Essentially, it's an external accounting firm that's tasked with substantiating the earnings of the company. So you generated the cash flow you claimed you generated. The easiest way to think about it is they're going to do a cash rec. So they're going to say, okay, you said you made X. We're going to go look to make sure that amount of money hit your bank accounts. And we're going to go match up all of the claimed income to what's actually showing up in a bank account. As it turns out, the QOV is not limited to a cash rec. It is more comprehensive than that, and it's intended to make sure that the financials are being accurately reported. This is not the fun part of a process for anybody. I've yet to have a client adore the due diligence process. It is a chore that is weathered. It is not a joy by any means. But doing some things in advance will make it a little less painful.
We definitely we used QuickBooks, which is very common, but we attached every single receipt in QuickBooks, and then we just gave them access to our QuickBooks. Go have a heyday, and it did make it a lot easier. I think something a lot of people really want to know, and I actually have my own opinions about this, but right now it seems like trades businesses are getting, just historically in my other industries that I sold in, if you got a 3x of EBITDA, you were, doing great. And
Yep.
yeah, so and that's basically what I got previously. But now, I got the 6x for Foster, and then I'm hearing other companies are getting 10x. What are some of the factors that are influencing that, and how long do you think that's going to last? Which is one of the things that I think I want people to hear on this. I personally don't think this is going to last forever, but you can give me your opinion on that.
Yeah, I don't have a macroeconomic crystal ball. If I did, I probably wouldn't still be working. So, but cheers. There's been a big shift, and let's talk about the bigger shift and why it's happened. So historically, trades businesses transacted to either the rich guy down the street and or within its own company, right? So that's to an existing employee, the second in command, or to a family member. And because there was relatively limited external appetite, that constrained valuations. So you gave the very typical forever, 20 years ago, if I saw a subcontractor or a trades business, you'd say it's a 3x trade all day. And maybe you could do a little better, maybe you're going to do a little worse, but depending on the nature of the company, but it's going to be right in that zone. What's happened over the course of the last 10 years is that there's been an influx of private equity money into the space. And they have said, look, normally these businesses traded for a relatively low multiple because there was concerns that they were susceptible to macroeconomic influences. So if there is a downturn, then they get crushed. If they tended to have more customer concentration and be project-based. Private equity stepped in and said, hey, if we make them big enough, a lot of these problems go away because your 20% customer concentration folded into a $1 billion revenue company means that the revenue concentration goes to zero, right? So I take away some of these concerns that had restricted the value. And so they started acquiring different people. And so you saw these strategic acquirers get really hungry for add-on acquisitions. And they started being able to pay more and more because the platform itself became more and more valuable. So any acquisition they were doing was accretive. So if they were worth 10x, they could buy a company for 6 all day, and that was still a great acquisition. That was still something that a deal they should do. On the other hand, and to your point, consolidations within industries have gone through historical cycles. So, and you can kind of pick your industries, but they build. One of them fails, and all of a sudden you start to see the platform start to be valued less, and they start to pay less for assets. And then, you get a couple of them that use a whole bunch of debt to do it. They don't have any, and then we get a little bit of an economic downturn, and a big one explodes. And now all of a sudden I have a depression of the total market and multiples at large. I can't tell you what's around the corner for our macroeconomic circumstance, but multiples contract when the macroeconomic environment gets worse.
Gotcha. Yeah, I just think, you know, that is going to happen at some point here. But so I want to answer Gemma's question. Is the multiple usually a lot less to sell to existing employees? One of the things I've struggled with, Gemma, I mean, that would have been my heart's desire to sell to my employees. But number one, I didn't have anyone that could actually be a CEO. But number two is employees I found were not able to understand the value of a business. They just had a certain number in their head that they felt it was worth. And so they don't understand this process, that there's an actual process behind that. So Blake, you answer this question, but that was my findings. So it definitely impacted what they wanted to pay.
There's an industry dedicated to this, so it's the ESOP industry. And there are certainly ways to do it. There's a constraint though, because most of the time, particularly in trades, the employees do not have sufficient capital, so they haven't saved enough money for them to be able to pay the equity portion of a transaction in full at the time of the sale. So what ends up happening is the ESOPs borrow a bunch of money, and essentially the guarantor of that money is the company. And then there's a seller note. So then you, as the owner, give a loan for kind of the balance to the employees, and you say, okay, over time, I'm going to get paid fair market value. The problem with it is you've taken on a fair bit of risk, because I've just levered up the balance sheet with senior debt, and then you layered debt on top of that in your seller note. So the default rate's relatively high, right? So just kind of mechanically is how that works. The other conundrum that you run into is you could always do something called a dividend recap. So you could always go borrow money and distribute it to yourself. You don't need to have an ESOP to do it. And at the end of the day, you'd still own 100% of it. There are scenarios where selling to your employees makes a ton of sense. If you have an exceptional management team, they are likely to be able to be backable by various private equity players who will make it possible for them to buy the company by kind of artificially engineering their way to a substantial ownership stake. But by and large, that's few and far between. For the most part, you're taking a discount, you're being awfully generous. And cheers, I think that's admirable, but it's normally not maximizing proceeds, particularly near-term proceeds for you. There are exceptions, but that would be my general statement.
Anybody out there, feel free to ask some more questions. I have one more that I missed. Will investments in technology, systems, processes help increase value as well?
Sure. Yeah, absolutely. It does it in a couple of ways. So this goes back to your first question, which is how are these businesses valued? Ultimately, they're valued based on free cash flow or EBITDA or SDE. And so if you can make investments into technology that improve margin and improve cash flow, then they pay for themselves very effectively and very efficiently. So I would encourage you to think through, hey, is this investment, and be that in technology or anything, is this an investment that's likely to improve the cash flow of the company? If it is, great, make it. The next portion of that is it also will help you inevitably through due diligence. So your ability to pull data, access data, and answer questions. If you've got the right technology tool to accomplish that task, it's worth a lot, because you've increased the probability of close. So I would encourage you to always think about these things on a probability weighted basis. So the answer is hey, if I'm increasing the probability of a successful close and not getting the discounts that come with kind of failing due diligence, right? So if you fail due diligence, People see increased risk, so they're willing to pay you less. So then they end up saying, hey, I know what I offered you, but I'm going to take that back. Now my number is this, and it's materially less than whatever they offered you up front. That's failed due diligence. If you can avoid that because you had the right systems in place, yeah, absolutely. That's only going to help you.
That's awesome. Anybody else? Any more questions? We're kind of running out of time here. Blake, I have one question I skipped. You know, how do buyers view backlog, pipeline, and job mix? So why don't you answer that, and we'll wait if there's any more questions, but we'll be kind of ending here fairly soon. So if you have any, put them in the chat box.
So, and this is another thing that if you engage a good advisor early, they're going to tell you, hey, start really developing out your pipeline. Start really documenting your backlog. A lot of folks, we have a client right now who's got a very big business, but his backlog is literally a whiteboard in his office and his GM's office. And he's like, yeah, I've got a great backlog. It's right up here on this whiteboard. I sit back and go, great, but what was it a year ago? Because I can't tell somebody that it was a great backlog if I can't measure it against what it was a year ago.
Which goes back to
And
systems and process and all that.
this is it. This is it. So if you've got the ability to document, hey, here's what my pipeline's historically been, and here's what it is, and here's what my conversion rate is, and here's what my contracted backlog looks like. Again, you're de-risking the deal. Someone's going to pay you more for the company because of it. And the more teeth I can put around that, the more legitimacy I can put there, the better off you are.
Awesome. Michael is typing, so we'll see. Thank you so much for coming and joining us. And it's an opportunity for me to also say thanks again for, one of the things I liked about Blake, which in all of the things that I have done, is that he works for the entrepreneur. It is not a transaction, like a transaction broker, but make sure you find someone that's working for you and represents you, because most of them don't. They're just trying to marry two people.
Well,
So
they legally, they're doing that because they can. So you need to be FINRA licensed, because otherwise you can't, you have to represent the transaction. So it's a little bit of a goofball nuance, but yes, I think it creates a conflict. It means you're not representing your client very well.
exactly. Emily.
Amy, I really appreciate the opportunity to come chat with you.
Yeah, thank you so much. And I think Emily's coming on here and she wants to say something.
Yeah, thank you so much to both Amy and Blake for all of the insights that you shared today. Like it was honestly really awesome, and I learned a lot. I'm sure everyone here did. And thank you to everyone who joined and asked questions and participated in the discussion. If you want to know more about Simpro, we encourage you to book a personalized demo with our team, so that we can help you solve any of the challenges you're facing and see what Simpro looks like customized to your business. I'll put that link up right now. Let's see here, promote. There you go. And then there we go. And then also stay tuned in your inboxes. Like I said at the top of the webinar, we'll be sending you a recording of this in case you want to revisit or even send it to a friend. You're welcome to share the information. We always encourage that. Community sharing is caring, right? And we'll also send you more information about sessions like this in the future. And speaking of, we actually have a session coming up next Tuesday, December 16th, where our team will be talking about some of the new features Simpro has built for businesses ready to level up their operations for 2026. And you can sign up for that through the link that I'm about to add here as well to the stage. Let's see here. There we go. Like I said, it's called Trade Tough, Enterprise Ready, New Simpro Features Built for 2026. And with that, thanks again, Amy and Blake and everyone for joining us. And we'll see you next time.
Thanks,
Bye-bye.
Emily. Thanks, Amy.
Thanks.